Imagine a government sitting in a room with the power to create money out of thin air. No printing press noise, just numbers appearing on a screen. And yet, despite this almost unbelievable ability, that same government can still find itself drowning in debt, struggling to pay bills, and on the edge of financial collapse. Which sounds absurd until you realize that money is not actually wealth. It is trust dressed up as numbers. And this matters right now because across the world governments are spending more than ever, borrowing more than ever, and quietly relying on this money creation power to keep things running, making it feel like there's no real limit. But there is. And it's not where most people think it is, because the system doesn't break when money runs out. It breaks when belief runs out. Here's how it actually works. Step by step, a government needs money to run roads, salaries, defense, everything. So it borrows by issuing bonds. Investors buy those bonds expecting to be paid back with interest. And as long as investors trust the system, this cycle continues smooth. But when spending rises too fast or tax income falls short, governments borrow more. And when borrowing becomes difficult, the central bank steps in, quietly creating new money to buy those bonds, effectively funding the government. Which sounds like a perfect solution, almost like a cheat code. Except it comes with a hidden cost that builds slowly and then all at once. Because creating money doesn't create more goods. It doesn't increase productivity overnight. It just increases the amount of currency chasing the same resources. And that's where inflation begins. Slowly at first, almost unnoticeable, then creeping into daily life. Food costs more, rent climbs, fuel becomes unpredictable. And at this point most people still don't connect it to money creation. Investors do. And this is where the story shifts. Because investors are not just passive lenders. They are constantly judging risk, constantly asking one question: will this money hold its value when I get it back? And if the answer starts to feel uncertain, they react. They demand higher interest rates or stop lending altogether. And suddenly the government's borrowing cost rises. Not because it ran out of money, because it ran out of ability. Now the irony becomes clear. The more a government relies on printing money to solve its problem, the more it risks making borrowing expensive, forces it to either cut spending, raise taxes, print even more money, each option carrying its own consequences. And this is not just theory. History has seen extreme versions of this, like when countries printed aggressively to cover deficits and ended up destroying their own currency. Their prices didn't just rise, they exploded, turning everyday transactions into chaos. Even in stable economies, the same mechanism exists in a quieter form, slow erosion rather than a sudden collapse, where inflation chips away at purchasing power while debt quietly grows in the background. And here's the uncomfortable math that rarely gets explained simply. The government owes trillions and interest rates rise just a few percent. Cost of servicing that debt can explode, consuming more and more of its budget, leaving less for everything else. And at that point printing money again might seem like the only option. Doing so risks pushing inflation higher, makes investors even more nervous, creating a loop that feeds itself. Now contrast this with the popular belief that governments can never go broke because they can always print money. Sounds logical on the surface but ignores the one thing that actually matters. Because going broke doesn't mean running out of currency, it means the curve.